In 1971, the United States made a financial decision that intentionally snapped the link between its currency and physical reality. For decades, the global economy trusted the US dollar for one reason. Anyone holding this paper knew it could be reliably exchanged for physical gold. Removing that backing overnight dissolved the decades-old guarantee of convertibility. Economists predicted that without a physical anchor, a paper currency would face a crisis of trust and eventual collapse. But the collapse never happened. Instead of crashing, demand for the paper dollar grew significantly stronger. The U.S. secured its financial future by engineering a system that tied its paper to the world's reliance on energy. To understand this system, we have to look at the early 1970s. Every modern economy faced a shared vulnerability. To run factories, power vehicles, and maintain their industrial machines, they were reliant on oil. Recognizing this universal need, the U.S. government approached Saudi Arabia, one of the world's largest oil exporters, with an offer. America would provide military protection and political support to the kingdom. In return, Saudi Arabia made a specific concession. They would price and sell their oil exports exclusively in U.S. dollars. This created a logistical hurdle for every other nation. If a country like Japan wanted to buy Saudi oil, they had to first acquire U.S. dollars. Soon, other oil-exporting nations within OPEC followed the exact same model. Every major economy needed America's currency just to keep their lights on. Central banks and international companies were forced to hoard large reserves of U.S. cash. By cornering the energy market, the United States turned its national currency into a mandatory toll booth for global survival. But this new setup created a logistical problem. Every time oil was sold, exporting countries earned billions in cash. They now had mountains of U.S. paper, and they needed somewhere to put it. Economists call this petrodollar recycling. First, money flows out of the West to purchase Middle Eastern energy. The real advantage lies in the second half. Those same billions of dollars are funneled straight back into the American financial system. The primary beneficiary of this returning cash is the U.S. government. With oil exporters buying up treasury bonds, America can issue debt and finance its own spending at low interest rates. The secondary beneficiary is Wall Street. Foreign investments pour into domestic stocks, real estate, and American businesses. By making dollars essential for energy, the U.S. engineered a global loop where the rest of the world continually finances American economic dominance. This self-reinforcing loop has given the United States a 50-year advantage in global trade. Today, however, that monopoly is facing friction. China is encouraging nations to begin trading oil in yuan instead of dollars. Russia has initiated a deliberate strategic reduction of its reliance on the U.S. financial system, and the broader coalition of BRICS nations is exploring alternative payment networks while increasing their gold reserves. Economists now question whether the current system can remain intact for another half-century. So the next time you see headlines about shifting global alliances or tensions in the Middle East, look closely. You are watching a methodical battle over the hidden financial engine of the world.